So I think the first thing that I would like to say is that the equity markets are not like a fixed deposit. So when you look at the returns of equity markets over 10 years or 15 years or 20 years, the returns have been very, very healthy, and I'm sure you've seen those returns when you've come to this asset class. But what's important to remember is that the returns don't accrue on a linear basis or on the basis of calendar years, because it is not a fixed deposit. There have been extended periods of time, maybe 1 year, 2 year, 3 year, where the equity markets don't do too much, and then there are periods of 1 to 3 years where the markets do a lot. So really the trick in this is to be able to stay invested for long periods of time, so that you eventually allow the good periods that the market enjoys to work to your advantage. As to what 2019 will bring, I've been in this market for 25 years, and if there is one thing I've figured out, it is that nobody can forecast what the market will do in the next 1 year. So I don't really have an answer as to what the market will do in 2019, but I would urge investors to look at this as a 5-year, 10-year, 20-year participation in the growth story that is India, and therefore the actual outcome for 2019 is not really material to that investment decision. I think certainly valuations have pulled back. When we look at the valuations on a trailing basis, which means the earnings that have already been reported, there has been a correction in valuations. I would not say that valuations have become cheap, but certainly it has dropped back into what we would call the fairly valued zone. If we look at the earnings on a forward basis, meaning the forecasted earnings of the next 1 year, then the earnings certainly are looking, the valuations are certainly looking like they have dropped quite comfortably into the fairly valued zone. But we must always be clear about one thing in equities: the future is always uncertain. So while we do look at the forecast, we don't treat it as an item of faith or 100% certainty that it will come through. But when you buy equities in the fairly valued zone, we think that over longer periods of time your outcomes are likely to track earnings growth, and therefore from that point of view, when equities are trading in that fair valuation zone, we think it starts to make the asset class look so much more attractive. So mid caps and small caps have been excellent performers going back to 2013. If you look at the performance that they have enjoyed from the middle of 2013 till even as of today, there has been significant outperformance by mid caps and small caps compared to large caps. Now, as a result of this significant outperformance, valuations of small and mid cap companies had actually moved to a premium to large cap companies, I would say pretty much during 2016 and 2017, and even at the beginning of this year they were at a premium. Now this is rather unusual, because the historical tendency is that the mid caps and small caps trade at a discount to large caps, simply because their business models in many cases and their balance sheets and financial health is not as strong as that of the large cap companies. However, with the weak performance that we have seen in mid and small caps, and I would say more so in mid caps during the current year, what is true is that the valuations have moved from a premium to falling in line with the historical pattern. It's more or less at par, I would say now, the large cap and mid cap valuations. So again, it has not dropped to attractive territory or cheap territory relative to large caps, but certainly the premium has eroded, and therefore at this point of time we actually believe that there is merit in starting to look at the mid and small cap space on a bottom up basis. Certainly there are a lot more opportunities today visible over there than there were 9 or 10 months ago. I think as far as earnings are concerned, what we have to see is that the last 4 or 5 years have been disappointment in terms of earnings growth. Even this year, compared to the forecast we had at the beginning of the year, there have been cuts to the forecast. So if you go back to April of 2018, the expectation was that earnings growth for, let's say, the Nifty would be in the region of about 24 to 25%. That number has now been cut back, and it's now in the mid-teens, about 14 or 15% growth. However, I do think that there is a degree of acceleration in the economy. Capacity utilization of many industries is moving higher, and as a result there is a case to be made that if the economy gathers momentum, this operating leverage can convert into much faster earnings growth even if revenue growth does not necessarily accelerate. So I think there is a case to be made that we will at some point see an acceleration in earnings growth, but I think for 2019 year ended March, there have been cuts to the earnings forecasts at this point of time, and therefore that will continue to be a little bit of wait and watch mode. I think for most investors, we believe that SIP is really one of the most efficient ways and elegant ways to invest in the market, because what it really does, if you continue an SIP over an extended period of time, there will be times when you end up buying the market at fair value. There will be times when you buy the market when it is expensive, but equally there will be times when you buy the market when it is cheap. And therefore, over a 10-year, 15-year, 20-year period, if you continue investing, your average valuations would tend to be similar to what the market has enjoyed. And then it is really the earnings growth which has a disproportionate impact on your returns, and not so much the valuations of the market itself. Also, I would add that remember the way markets work. When the news flow is very positive, equities tend to be rich. In other words, valuations are high. On the other side, when the news flow is very poor, equity markets tend to trade cheap and valuations are very, very low. And the entire purpose of running an SIP is to make sure that you have an investment plan which is defined beforehand, which ensures that even during bad times, you continue to invest in the market. My own experience with investors has been that they are very willing to invest when markets are expensive because the news flow is good, but they find it challenging to invest when the market is cheap because the news is bad. And when you do an SIP, you sort of address this behavioral problem that many investors experience, and therefore it actually improves your long-term outcomes. So I would actually suggest that when the market falls, you should certainly continue with your SIP. In fact, that is the very reason why you have an SIP, to do something which you might otherwise find difficult to do, because when markets are cheap, as I said, the news flow tends to be poor. So I would certainly urge investors to continue with the SIP.